Hi, everybody, and good afternoon. Thanks for joining us for the Thrive in 25 series with Westcliff Asset Management. We're excited today, Addie and I, to join Simon Reddish from Durum Capital. This is the third webinar in our series about Thrive in 25, and today we'll be focusing in on industrial real estate, specifically with Durum Capital. We'll start today with the outcomes, talk a little bit about Westcliff and what we do as a business. We'll cover off Simon Reddish and Durham Capital, and then talk through the investor presentation. Addie and I have some well thought out questions for Simon as we dig in Durham Industrial REIT opportunity. And then, of course, share some next steps and disclaimers as expected. A bit about the Westcliff team. So my business partner, Adi Saeed, he's a experienced realtor and more in the investment real estate space for about 18 years. He is a registered dealing rep with Waverly Corporate Finance. Myself, I'm Kaz. I'm a registered dealing rep also with Waverly Corporate Finance. About a 20-year career in real estate finance and accounting spanning Canada and the US. We come together as part of a team called Westcliff, where we work with a number of issuers, individuals, and real estate investors. Our business strategy and our ethos as a company is really around three major elements: learn, invest, and manage. On the learn side of things, we focus on investor education. And so we provide a lot of podcasts, webinars like this one, and other content. In other words, to provide opportunities for investors to learn more about real estate investing, whether passive or active. On the invest side of things, through our strategic partnership with Waverly Corporate Finance, we're able to work with investors to find investment opportunities that might meet their suitability and other criteria, specifically with accredited and eligible investors. There's some links below if you'd like to learn more about that. And on the managed side, we do active asset management, more on the real estate side. We work with our clients to help them manage their investments so they don't have to. And so really creating a truly passive opportunity. So our overall ethos: learn, invest, and manage. So if you want to learn more, we'll have some information at the end of the deck where you can reach us and how you can get a hold of us. So with that, let's turn it over for Simon. I'd love Simon for you to kind of introduce yourself and tell us what kind of brought you to Durham, and we'd love to learn more about you a little bit, and then we'll dive in a bit more into the brass tacks of the investment.
Yeah, absolutely. Thanks, guys. So yeah, I've been at Durham just over 2 years now. So I manage all things real estate. So today we're focusing on our industrial REIT. We've also got a land development division as well. So I manage the fund, the day-to-day, overseeing the capital raising, the property management, the leasing, everything holistically to manage this fund. My background, I've worked at Ivanhoe Cambridge for 8 years prior to joining Durham. So they're one of Canada's largest pension funds and work through asset management, investments, appraisals, leasing, and development. So touched on a lot of different areas of commercial real estate. One of the things I really like and drew me into joining Durham is, Durham thinks very creatively and looks to find value often where others don't find value. We're not afraid to roll up our sleeves and get things done, and focusing in on different types of investments that others may not want to take on. So that was kind of one of the things that I really like and sort of drew me into joining Durham.
Awesome, and that leads in really well, I mean, into the next slide. Some of the folks on the call and people listening to the webinar may not have heard of Durham or Durham Brownstone. So maybe if you can give just a bit of a history on the company and kind of why it might be a good opportunity for folks.
Yeah, absolutely. The company was founded by Jay Simmons. It started off with a lot of his own seed capital, and he's got his own seed capital in all of the 5 funds here. And then it got to a point where we needed to bring in more capital to be able to take advantage of the opportunities that we were seeing. So we've got our industrial REIT. It's pure industrial REIT focusing on the prairie provinces of Canada. Durum Developments, we have a large land parcel on the west side of Calgary, and we're in the process of trying to acquire a few additional land parcels around Calgary as well. Then the Carbon Fund trades in commercial carbon credits in Alberta. And the Opportunities Fund looks at sort of stressed and de-stressed investment, bridge financing, short-term solutions to help good companies with bad balance sheets restructure and sort of get through difficult times. And then Brownstone is our sort of traditional asset management firm that does everything on the listed side.
It's interesting that we're going to be
So
focusing more on industrial REIT, but I want to ask, what sort of returns do you expect on the other buckets that you have here?
Yeah, I mean, it's mixed. The development is a much longer term investment. When you're in land development, you got to be looking sort of 5, 10 years out. But you can get really strong upside at those points when you can get land use and when you can start selling those lots. Most of on the development side, we'll be looking at more on the commercial side as opposed to the residential. But one of these parcels that we're looking at to acquire will have a big residential component to it. It's hard to say exactly what the returns would be on that because land development's more speculative. Carbon's in a really interesting space with the upcoming elections because there's a lot of uncertainty around the whole axe the tax regime, but these are the commercial carbon credits. So historically, we've had a number of funds, and the first fund had annualized 32% return or 16% over 6 months. And the second fund was sort of low single digits. But that's kind of in a holding pattern right now, just till after the elections. The opportunities fund is sort of also in that low double digits returns that they go, but it got a slightly higher risk profile than the industrial REIT.
Or do you focus on the opportunities on more like what type of assets? Because you have an industrial, but do you focus on like industrial in your opportunities as well?
No, the opportunities funds that they look at, I mean, they've got a dog food company in there that they help restructure. They've got an HR firm that they invested in, and they've been accumulating numerous HR firms to then sell a larger portfolio of HR companies. They've got some oil and gas drilling. They've got a gondola project that they help finance. And there's a whole array of different small businesses in Canada that they've helped restructure and refinance. So it's industry agnostic. Yeah, it's an interesting one.
What would be good to kind of talk to people about here a little bit would be just to kind of educate a little bit on industrial real estate. Most accredited investors have some multifamily exposure, are used to the residential side, understand even the dynamics around that. But for listeners, this might be a new asset class. Maybe you can provide some context and some overview for them on industrial real estate.
Yeah, absolutely. I mean, industrial real estate is, we're talking about commercial, factories, distribution facilities, manufacturing facilities. There's a huge amount of demand for industrial. Pretty much everything we touch in our lives, every time we click something online and purchase a product, it's been manufactured in an industrial facility. It's been packaged in an industrial facility. It's been shipped out of an industrial facility. So it is truly the real estate that touches all aspects of everything we do in our lives. It all comes and is built in manufacturing. Here shows a list of different types. So there's industrial that can be considered like just yard space. So some tenants just need to store their trucks or trailers or equipment in a giant yard. Other tenants need high-tech manufacturing in a custom facility specifically built for them. So it's a pretty broad catchment of different types of uses that all sort of fall within the industrial real estate umbrella. But we've seen really strong demand, particularly during COVID, from tenants. So the industrial real estate sector across Canada is very much in an investor-friendly state of the market. Obviously, market cycle up and down, but industrial is steady, it's dependable. Typically, we have really long-term leases, anywhere from 5 to 15-year leases in place. The structure of those leases is very favorable to investors. It's triple net leases, which means that essentially the tenant pays for all costs, all maintenance, taxes, any problems with the building, the tenants pay for that. Sometimes if those costs are large, the landlord will fund them and then will bill the cost back to the tenant over a 5 or 10-year period with an interest rate attached to that as well.
What do you think about the supply and demand of industrial space? Over the years, we've seen quite a run up on valuations and pricing for actual industrial sites. So what are you seeing in the market?
Yeah, you've got to segment it in the type of space in the market. If we look at really large bay distribution facilities, like where the Amazons and the Home Depots and the Ronas of the world have their distribution facilities, that space really got saturated coming out of COVID. A lot of developers were building a lot of that space. So most of the vacancy in the market across Canada is in that large bay distribution space. But as you break it down and look at smaller buildings or multi-tenant buildings, it's very, very competitive. And in all the markets, we're sort of sub 4% vacancy rate. So it's very much a landlord-friendly market to be in. And in the market like this, we can negotiate favorable lease renewals or lease deals.
Okay. And then the classic question that's on everybody's mind nowadays is about tariffs and the impact on the underlying tenants here. Obviously, a lot of them would be selling into the US. And so how do you see some of those dynamics impacting the fund?
Yeah, it is an interesting time for sure. A lot of our tenants, we're having regular conversations with tenants. We have a lot of tenants that are just their business is purely within Canada. So they're going to be insulated a little bit more than sort of large multinational firms. I think everyone's kind of in a little bit of a wait and see pattern just to see what actually unfolds. The news seems to change on a weekly basis in terms of duration of tariffs, when they're kicking in, how long they're going to be in place for. Things that are for sure going to be impacted is like if we're building buildings, steel costs are going to go up. Absolutely. Concrete doesn't seem to be impacted much, nor does asphalt, but HVAC equipment is going to go up. So it's hard to have a crystal ball and know exactly the true impact. It is different in different sectors, and in construction, it's definitely going to have significant impact. We typically aren't developing buildings ourselves. In our industrial REIT, we're buying pre-built buildings that have income producing tenants in place, and those tenants are obviously tied to long-term leases. So that does help to mitigate any volatility in the market because our income stream is very protected over a long period of time.
Well, Durham targets 8 to 12% annual returns. What specific factors allow you to achieve these consistently? And do you see any deviation from those numbers given the headwinds that they're facing in the marketplace right now?
Yeah, a big portion of the return is the yield that we're able to generate from essentially the rent that the tenants pay us. We distribute that rent, and it's in the Series J unit that we're discussing today. It's up to a 7% yield, comes directly from the cash flows of the assets. And then the rest is through appraisal gains. So in an inflationary environment, typically prices increase at a higher rate. And so to get to that 10 and 12% return, we're seeing 3 to 4% appraisal gain each year.
And has that been what has happened in the past? It is 2 to 3%.
Yeah, historically, our appraisal gain piece has been fairly closely tied to inflation each year. And having the investment in industrial real estate helps you mitigate. It's a hedge against inflation, essentially, because your prices, your buildings are going up with inflation.
What kind of leverage do you have, that leverage for your assets right now in the fund? And what number do you use when you're acquiring?
Yeah, our fund leverage is about 63% at the moment, and we have the ability to go up to 75. We'll look on a new acquisition or in a refi. We'll look at the market. We typically will go out to 10 plus lenders and really get a good price in the market and a sense of what debt providers are looking at. In the last year or two, there's been a lot of lenders really trying to focus specifically on industrial. A lot of that's driven by the challenges in the office sector, and a lot of lenders were over leveraged in office, and the prices of office buildings have been coming down considerably since COVID. So a lot of debt providers are trying to reweight their books into more industrials, which makes it great for us because we have a lot of opportunities and we get to pick and choose between who's offering the most favorable rate.
So what kind of rates are you seeing right now for industrial?
Slightly, I think we're 4.85 was the most recent renewal we did last month, and that was on a 5-year fixed interest rate. So I think we've subsequently had a cut to interest rates as well since then, so it'll be sub that going forward.
Any tenant defaults or widespread lease non-conformance, non-renewals?
No, we've got very good, stable tenants in place. Even during COVID, we had 0 defaults. All the tenants paid rent the whole way through COVID. We look very closely at our tenants when we're doing a renewal or when we're doing a new lease or when we're acquiring a building with tenants. We'll really dig into the tenant's financial position, ensure that they do have a strong financial position to be able to pay rent. And we've got lots of tenants that are huge multinational firms that earn over $15 billion per year. We ensure that the tenants that we do have, rent's not going to be a problem in their business.
Simon, can you just walk us through what key investment principles that you follow whenever you guys are making acquisitions? What sort of top pipeline do you guys carry? Do you have any pending acquisitions right now? Just walk us through what it looks like when you're making an acquisition.
Yeah, absolutely. There's a lot of different things that we look at, as I just mentioned. So the tenant itself and the credit of that tenant is important, but also just the physical building. So we look at the building, the location, we'll look at the market and all the market dynamics in whatever market that building's in. Physical things like the clear height of the ceilings dictates how many levels of pallet racking you can put up inside the building. We'll look at access to highways, access to rail, truck courts, how many loading dock doors there are, the square footage of and proportion of office to industrial space. And then we look at all the physical things like the roofs, the asphalt, all the mechanical. We look very closely at all aspects of the building and the market to ensure that if we're buying a building, if that tenant ever leaves, we want to be comfortable that we'll be able to backfill that space quickly and easily, and it's not a super unique building tied to a certain type of use. We're looking across the Prairie provinces regularly. I'm always talking to different brokers. We also are plugged in pretty closely to in the insolvency space as well. So if there's companies that are going under, we like to get a look at their buildings because sometimes you can get sort of really attractive off-market deals in that space. We've currently got about $250 million worth of active deals in our pipeline that we're looking at the moment. We obviously won't close on all of those, but I like to have a very holistic view of the market and know exactly what's on the market at any given point in time. And we don't have any under contract right now. There are a couple of buildings that we like and that we're sort of doing due diligence on at the moment.
Do you guys have any synergistic opportunities with your, let's say, opportunities fund that is more looking at obviously build businesses, it's more private equity? Do you find synergies between the different funds and do the funds sell to each other?
They don't sell to each other, but sometimes there are circumstances where the opportunities fund will be underwriting a business and there is an underlying industrial real estate attached to that business, and we'll come and look at that. We haven't actually done a deal in that manner yet, but there has been a few opportunities like that we've looked at.
What's the biggest risk do you see in your current investment strategy?
The biggest risk is some big macroeconomic event that has an impact more broadly on society. I think the assets themselves are very stable, predictable, they've got dependable cash flows. So it would have to be some much bigger macroeconomic event that triggered something. And that would obviously affect all of society and not just industrial real estate.
Yeah, the problem is that a lot of times when investors are invested in a specific funds, they don't care about the rest of them. They just care about you.
No, I get that. Yeah. I mean, industrial compared to other asset classes of commercial real estate, industrial is more predictable. It's very dependable. As I said, we have very high credit, long-term leases to high credit tenants. You compare that to multifamily, for instance, and they're typically on 12-month leases. There's a lot of turnover. There's a lot of roll. There's also a lot more maintenance. So you might have 400 units compared to one industrial building. So you've got 400 toilets, 400 sinks, 400 dishwashers, all of those things that you need to be maintaining and keeping in a good status. Well, the industrial warehouse, typically our tenant looks after everything because they're on such a long-term lease and the structure of that lease. We ensure that they do look after it. We inspect our buildings multiple times a year. And if there's any deficiencies we see, we'll ensure that they get fixed in a short period of time.
And do your leases are mostly net leases that you have?
Yeah, they're
So the
all
tenants are
triple net.
responsible?
Yeah, so the tenant's responsible for essentially all costs.
So you guys are mostly in Western Canada, Alberta, Saskatchewan, and Manitoba. Which one is the latest acquisition or the latest province to join in your portfolio, and why did you guys pick that?
Yeah, so Manitoba's been our latest province that we've joined. It's got very similar characteristics to Alberta and Saskatchewan, very similar return profiles as well. The reason why we are Prairie Province focused is typically we can buy a building here at about a 200 basis points higher yield than we could for an equivalent building in Vancouver or Toronto or in Quebec. And there's more investors focusing, more pension funds and international investors that really just focus in Vancouver and Toronto. So there's more investors chasing deals and that brings the pricing down. So the markets we're in, there's less competition and we're able to generate a higher yield by being specifically focused in the Prairie provinces.
Now, and I noticed like your presentation had somewhere that the availability rate is 4.2%. For our viewers, can you explain to them what an availability rate for industrial is and how that impacts the valuation of the property and the rents?
Yeah, so the availability rate is essentially the vacancy rate in the market. So with a 4.2% vacancy rate, that's saying if there's 1 million square feet, there's 4.2% of that would be vacant at that point in time of the statistics. So obviously the higher the vacancy rate, the more options the tenant has, and meaning the more power that the tenant will have in a lease negotiation. Typically about sort of 7 to 8% would be a market in equilibrium. So at 4.2 today, it's very much still a landlord favorable market where we're able to negotiate heavily and in favor of our investors in lease deals. So obviously, the higher the vacancy, the more options a tenant would have.
Guys, you have questions?
Yeah, I was thinking about there's a slide here that talks a bit about an acquisition. It might be good for you to walk through what led in Winnipeg. You specifically mentioned you just entered Manitoba. We need to talk a bit about a specific deal. Some people can get something more tangible to understand the investment a bit better.
Yeah, absolutely. So this building, it's in an older industrial market in Winnipeg. There's essentially, it's quite landlocked, so there's no new industrial developments happening in this specific market. So this building, it's 106,000 square feet across 4 separate buildings. And one thing on particularly what I like about this, so it's currently leased to one very large multinational, and they lease all 4 buildings. They've got about 5 years left of lease term on their existing lease. It is leased under market by about 10%. So at the end of the lease, we'll be able to increase the rental rates to market rates. But also in the event that the tenant doesn't renew in this building, it's already broken. It's already 4 separate buildings. So it'll be very easy on this building to lease it out to 4 separate tenants, just because that's the way it was already constructed. Specifically on this building, another thing is, as we were doing our due diligence, became very apparent to us that the previous owner had neglected the buildings, and there was significant capital work required on these buildings to bring them back up to a market standard. Since acquisition, we've put new roofs on 2.5 of the buildings, and you can see some of the pictures on the right-hand side here and in the after column. And we've put 12 new rooftop HVAC units in. They were in varying state of disrepair, and some of them weren't even working. We're the last thing, put paint on the exterior of the buildings, and then the last thing we're going to be doing this spring is some asphalt work. So as we uncovered all of that during our due diligence, we were able to negotiate very favorable price reductions to account for the work required and the work that the previous owner didn't complete. So we've been working closely with the tenant, keeping the tenant very much involved in everything we're doing, because essentially the tenant pays for this. So the tenant's actually very happy with all the work we're doing, and the relationship that we're developing there is good. And then we've been able to increase the value of the building considerably since acquisition.
With all the capex you're putting in and the fact that the rents are, call it, next 5 years at least, a little bit under market, how does that impact the NAV of the fund? Like, how do you maintain? Is it accretive to the fund still? Because it definitely does have a drag on cash when you start making capital investments.
Yeah, it has a drag as you spend it, but typically you would get a catch up when you reappraise the building at year end. So we appraise all of our buildings once a year, and the appraiser goes and inspects the buildings, and he compares them to comparable properties of an equivalent quality. So on this particular building, yes, we spent about $1.5 million of capital work last summer, but we were able to significantly outpace the capital work we did in our appraisal gain.
Yeah, my question was around how much did you buy it for and how much did you spend?
Yeah, so we bought this building for $11 million. We spent about $1.5 million on it, but then we had it appraised at about a $14 million price within
That's
12
a nice
months.
bump.
Yeah.
Good story for investors.
Yeah, so it goes into when we're looking at deals, if there's value to be created through leasing or through capital improvements, we find that really attractive. But on a complex of this size, a lot of the big pension funds and large REITs, they wouldn't waste their time on this and doing this level of work on a building. They would sooner rather just buy a building that's a much newer vintage building, and it may have a lower return, but it's less work for them.
Talk a bit about the kind of the investor profile, what is a target investor for you? And maybe talk a bit about some of the attributes of the fund that might be good, especially specifically the Series J, I think is the most relevant one for this case.
Yeah, absolutely. So we do have a few different series of units, but the Series J units that we're offering here, we take anything from a $10,000 investor or $7,000 if it's through a sort of tax account. All eligible tax investments we can take in to the fund. The unit price is the greater of trading NAV or $100. As I said, we're targeting a 7% preferred return, and that's just comes through the cash flow, or up to 7% comes through the cash flow that we generate out of the underlying assets. And then our target return is 8 to 12%. If you do it, essentially, you reinvest your dividends back, you get a 2% discount to the current price. Our maximum offering is 100 million. That sort of ties in with the pipeline that we would like to be able to be investing in some of these larger portfolios that we're seeing at the moment. So we have a 1.75% management fee. We do have a 20% annual. Essentially, it's the manager can earn up to 20%, but it's based over an 8% hurdle, and there's a high watermark as well. So we have to keep significantly earning more than 8% per annum to earn that. And yeah, so we have a redemption period of 150,000 per quarter. We've never gated redemptions. Life happens, and if investors need to pull their money out, we'll happily work with them to allow that to happen. And as I said, we've never gated redemptions in the 8 years we've been in operation.
How do you ensure adequate liquidity in case of redemptions?
So we have 2 lines of credit available there in the event we need to draw upon them for things like this. And then we keep cash in the fund as well that can be spent on redemptions or on sort of more emergency capital improvements as well.
Can you talk a little bit about your redemption restrictions, if there are any?
Yeah, so there is a redemption penalty over the first 4 years, essentially. So it's 2% per year penalty. And then after the 4th year, there's 0 penalty.
So year one, you would get 92% of your initial capital if you redeem it, and then 94, 96, 98, and 100.
Correct. Yeah.
Right.
Yeah. So just given that industrials, it's a longer term investment, we do like to have investors aligned with us and be in there for a longer period of time.
Do you know if there's any pending regulatory changes that could impact your operations?
Not that I'm aware of, no.
Yeah. Well, so do you think the tariffs would have a negative impact or a positive impact on your business?
As I mentioned earlier, I think the tariffs, it's a very unique period of time and there is uncertainty in the market, absolutely driven by the tariffs. That uncertainty ripples across the broader economy. Some of our tenants do have, as I mentioned, we have a few multinational tenants. So those companies, they're going to have more of an impact to the tariffs than a lot of our sort of more local companies as well. So it'll be mixed across the portfolio, but we're regularly talking to our tenants and we're not hearing a huge level of concern out of them in regard to the tariffs.
Anything on the portfolio? I think we've talked a little bit about. I think it was interesting to look at your lease expiries, a lot of them long term, as you mentioned, and then the types of industrial was an interesting mix in terms of your tenant composition. Anything you want to comment on the portfolio?
Yeah, we do have a very long-term staggered expiry profile, so we don't have any one year with a huge amount of risk from tenants renewing. And obviously at the end of their leases, that's the point in time which some tenants, they're growing and they need to move buildings to accommodate their growth. But we like to stagger our lease expiries, so we don't have any one year with a huge amount of risk there. We are Prairie Province focused, where obviously we've got a lot of our assets in Alberta, but we're not heavily tied to the oil and gas industry. We have a fairly diverse mix of tenants, and that helps sort of mitigate any potential impact that any one sector may see at any given point in time. It all plays into the sort of the stability and the dependability of the cash flow that we are able to generate.
And you referenced the Prairie provinces in Western Canada. Are you guys looking to continue to stay in Western Canada? Are there plans to take other markets? How are you thinking about that?
Currently, we are looking primarily in the Prairie provinces, but we are opportunistic by nature. And if an interesting deal comes across my desk that is in a different province and we think we can generate an appropriate level of returns out of it, we'll absolutely look at that very closely. But our primary focus is the Prairie province, but that may change over time.
Actually, there's the Edmonton acquisition. Can we talk about this one?
Yeah, absolutely. So this is our most recent acquisition. This one, it's a sort of distribution company. So they distribute a lot of construction products to hardware stores and to homeware stores. The owner owned the company and the asset. He retired and sold his company, but kept hold of the asset. And then he was trying to simplify his life. So we did an equity roll in where he took $1.7 million worth of units in our REIT as part of the closing. So he likes industrial real estate. He wanted to continue to own industrial real estate, but he wanted to do it from a passive position. From this investor's standpoint, he was able to essentially go from owning one building to owning an interest in 19 buildings and having a much more broad, stable portfolio of investments versus the single building. And the building itself, it's a great building in a good location in Edmonton, and it's got really good bones. There was a lot of capital work spent on it prior to acquisition, so it's got brand new roofs, a lot of new mechanical equipment, and new paint on the building.
Yeah, equity roll-in is always very interesting. We used to working at Equiton. One of the things that we always looked for is trying to find owners that would do an equity roll-up because we don't have to go raise the money. It's cheap
Yeah,
money that is
absolutely.
available.
Yeah, no, it definitely has a big benefit to the fund and to all the other investors in there as well. So it's something we're actively looking for other equity roll-in opportunities. They don't come across at my desk as frequently as I would like, but they're out there.
Any other interesting acquisitions that you guys have done over the past couple of years that would be a good story to share?
Yeah, I mean, there's one other acquisition. So we had a building in Calgary that was an older vintage, had low ceilings. The business itself, the tenants in there, a few of them left at the same time. So we were left with a large vacancy. We had tenant concept come in that essentially was like WeWork for industrial. So it was co-warehousing space. So if their subtenants essentially are people who sell on Amazon, who sell on Etsy, who sell on eBay, but they had outgrown their house and they needed space. That tenant didn't actually eventuate, but we liked the concept so much that we entered a tenant called ShedPoint, and we've got another business, called ShedPoint that essentially does exactly that. So we lease out 12-foot by 12-foot blocks of space obviously at a much higher price, but we offer them amenities. There's conference facilities, there's a gym, there's a kitchen. So it's a unique proposition. And it also sort of points back to our founder, Jay Simmons, that we had a problem, we had a vacancy, and we solved that problem by essentially creating a tenant. And now that tenant is a healthy company that stands on its own 2 feet and pays us our monthly rent to the REIT. And now that tenant's looking for more opportunities to grow across Canada.
There's like WeWorks for industrial and
Yeah.
Etsy.
Yeah, just think WeWork for industrial. That's the easiest way to compare it.
That's a very cool idea. What kind of premium do you guys see on the rents on something like that?
Yeah, the lease to us. So the Durum Industrial REIT receives market lease. So the REIT we've got a long-term lease in place with that company. They pay us market rents. There's a lot of cost goes into operating that business. There's 3 full-time staff in the building. So they have to obviously charge a higher rent to cover all of their operating costs for operating the business, but they are definitely able to achieve quite high rental rates compared to someone renting a full 60,000 square foot building.
In terms of the fund itself, and how much of the fund is actually owned by Durham itself versus outside investors? In other words, how much is management actually own of the fund?
Yeah, there's just under $12 million owned by management and our board of directors. So we're heavily aligned with the performance and with the investors in the fund. Our CEO, Jay Simmons, he's got a lot of that money is his own money. So he's very much involved in the day to day and ensuring that it's heading in the right direction and that there's no big risks. We have a very strong governance team and board of directors, some of which are personally invested in the REIT. They keep us very much accountable for all of our major decisions, and they're very active in everything that we do as well.
And when you have a new acquisition or a financing, how is the board involved in that?
Yeah, so we'll like on a new acquisition, we will go and do all of our due diligence. We'll underwrite the opportunity. We would essentially put in an offer subject to board approval, and then we would take the opportunity to the board and present all the financials of the investment opportunity, any risks, all of the things I covered earlier in this conversation. And then the board would have to approve that we proceed. So we can't proceed without their approval. And similarly for financing, so we'll go out, we'll price the market. Essentially, we put together a table with all the different lenders and what the rates that they're offering and all the different terms of the debt. And then we present that to the board with a management recommendation, and we need their approval before we can lock into any of those contracts.
And with the last couple acquisitions, were they fixed or variable debt? Like, how were you looking at it?
We went with fixed debt. Primarily, we go with fixed debt as well across the portfolio. We just find that the market moves, and in recent years, it seems to move quicker than historically. So it just locks in our debt and locks in the risk profile for a 5-year period.
I'm just looking through your acquisition pipeline over here and looking at these cap rates. This is amazing. Like 6.4, 7% cap rates. You don't see that in Toronto, especially a couple of years back when we were seeing cap rates like in 3s and 4s for industrial. How are you guys sourcing these deals? Do you guys have internal sourcing, internal people that are looking for these deals, or are you working mostly with brokers? Can you walk us through a little bit more on that side?
Yeah, absolutely. The three paths that we fund acquisitions, that we obviously look at everything that's publicly listed. I speak with brokers in all the markets that we're invested in, probably on a monthly basis, and just trying to get a read of the market, what's coming down the pipeline. Are there any off-market opportunities that we can look at? Some of these are off-market opportunities that a broker or an investor knows about that's coming down the pipelines that we sort of get a sneak peek at before it goes to a public listing. And then also, as I mentioned earlier, we look if anything's distressed or goes through the insolvency space. We're tied into a lot of the big accounting firms that run those processes, so we get a look at those assets as well. So it's probably, I would say, 60% publicly listed, and then the delta would be off-market and distressed opportunities.
These cap rates look amazing. So it's very interesting to see the difference between Ontario and BC and what's happening in the prairies. You guys have a size of 133 millions. You guys have any targets, have any numbers to achieve? What does 5 years look like for Durham?
Yeah, my goal personally, which is all predicated on being able to raise the appropriate amount of capital to do this, is I'd like to get to sort of 500 million in 5 years. It might be a bit of a stretch, but that's kind of where we're aiming. As you grow your portfolio, any one tenant or any one building has a lesser impact on the overall performance of the portfolio as well. And I think predominantly we'll be growing in the prairie provinces, but we'll look at opportunities elsewhere as well.
So as a fund, you probably have restrictions on how big of a property you can purchase. Out of these ones that you have listed, I would imagine like the $70 million probably not going to be in the wheelhouse.
Well, so the top 3 in this list are portfolios of multiple buildings. So I would say typically on an individual building size, where, in that sort of $5 to $20 million range, seems to be a bit of a sweet spot for us. A lot of high net worth individuals, once you get above 5 million, a lot of them get capped out. And then a lot of the large REITs and the pension funds, they're looking for much larger assets as well that move the needle for their portfolio. So they're typically not playing in that sort of $5 to $20 million space. That seems to be our sweet spot that we target.
It's funny because we have the same thing. We target mid-market investors because we find that the institutional investor already has all the tools that they need. It's this mid-market and smaller investors that don't have the tools that they need to be sophisticated, and we help them invest money into assets like these. So it's a very nice bracket to be in for sure.
Absolutely.
I was curious, you mentioned the first 2 there on the list are portfolio level acquisitions. How do you look at portfolio acquisitions differently from individual assets? People aren't just throwing in lemons as part of the overall basket. Like, how do you evaluate the portfolio versus maybe just picking off individuals?
Yeah, we'll underwrite every individual asset in the portfolio the same way we would underwrite a standalone asset. So typically we won't buy anything that we consider a lemon, even if it comes in a portfolio. So the investors that are selling these portfolios are kind of unique because they're large investors that own a diverse array of different asset classes in commercial real estate. And the driver that what I'm hearing in the market, the driver why they're looking to offload industrial right now is because their values have been eroding so quickly in office that they're trying to liquidate assets that have liquidity right now in the market. So they're looking to offload industrial essentially just to help balance their own books. So they may not necessarily be wanting to sell these assets, but the assets that there's a market for right now.
And how's the capital raising going in terms of whether you're attracting family offices, high net worth individuals? Like, how's that going in general? What kinds of profiles of people are you seeing interested in investing in the REITs?
We have a very diverse array of different types of investors, anywhere from an individual that puts in 10 grand out of their tax-free savings account to an individual that might put in a couple of $1 million into the investment. We do have a number of family offices that have been invested in the portfolio since inception, and we are actively speaking to other family offices as well that would come in and help us on some of these larger portfolios. So we speak to the full gamut of investors. I would say we don't speak to institutional investors. It's typically from an individual to a high net worth to a family office, are kind of where we speak.
And they're mainly Canadian or anybody overseas?
Primarily Canadian. There's a few US groups that we're speaking to as well, but I would say 90% Canadian.
And what attracts them to your fund versus others they might be looking at?
A lot of it is the off-market opportunities that we're able to show them before they can see it listed publicly. And it's some of our experience in creating value through capital improvements and also in the distressed and insolvency space as well. That's not a space that a lot of people have familiarity with or understand how to navigate that space. And we're fairly unique there because our founder spent 20 years at Deloitte's leading their insolvency practice. So he's very well versed in navigating those sort of distressed opportunities.
This is a question that we should have asked at the very beginning, but why Durham and why not the other industrial REITs? So we sort of missed it. So can you just give us a quick rundown? Like, what are the top 5 reasons somebody would invest in Durham?
Well, we're industrial focused, we're Prairie Province focused. We really look to create value through accretive capital improvements or through accretive leasing. We've got a diversified, stable portfolio currently, and we're looking to grow in these markets as well. We're fairly unique in the sense that there aren't other Prairie Province focused industrial REITs. There's a lot of industrial offerings that, on a national basis, but you look at the cap rates on this page and there's no way that if you're buying a Toronto building at a 4 cap rate, there's no way you can be paying a 7% yield. It's just not possible. But we're able to pay a higher distribution and a higher yield because of the locations that we're invested in.
Is there ever going to be a development potential for any of your properties?
There are some properties that have a longer term development potential. I've got a lot of development expertise in prior roles, so we are looking at what we can do and how we can unlock value. But also we have to be mindful that if you do a development, essentially you're forking out a lot of capital to do that development and you have no income for a 2-year period. We need to be very carefully balancing that with being able to pay our investors the yield that we're promising them.
One last question that I have is, what's the exit at the very end?
Our founder wants to grow this portfolio and keep growing it. So we're viewing this as a very long-term portfolio of investments, and we're not looking at it in a closed short-term 5 or 10-year fund. We look at things very long-term view, and we look at assets that we want to own for a very long term as well.
I had no other questions. Adi, anything else you wanted to cover off with Simon?
Oh, I think we can start wrapping it up.
Thanks, Simon, for joining today. Just for our listeners, as far as next steps, if you'd like to learn more about Westcliff, you can book a call with us at the link below. Listen to our podcast, which is published every Friday. Join our online community called WIN, which is the Westcliff Investor Network. And of course, follow us on all major social media. We're on everything from TikTok to Instagram to LinkedIn. You'll see our faces a little bit everywhere, where we're looking to help our investors and people like yourselves learn, invest, and manage. And then finally, any questions? And you can text us at 647-799-2264. Our email address is info@westcliffam.com. Visit us on the web, www.westcliffam.com. And if you want a copy of these slides, text us 647-799-2264. We'd love to stay in touch with you. Thanks for joining today. The last couple slides are our disclaimers from both ourselves and Durum. And thank you, everybody, for joining today.
Thanks, Simon, for being here.
Absolutely. Thank you all.
Thanks.